In 2025, gold rose 65% measured in US dollars. The S&P 500 measured against gold fell 28%. Most people did not feel that. They looked at their account statements, saw the same numbers as the year before, and assumed they were holding ground. They were not. That gap between the nominal number and the real number is the exact gap that opened in Weimar, Germany between 1921 and 1923. And it is the gap Ray Dalio has been pointing at for the last 6 months. I am Reid. This is the Reid Briefing. Here is what you need to understand. Dalio has spent his entire career decoding one specific pattern: what happens to wealth when a heavily indebted reserve currency country starts to lose monetary discipline. He has written about it. He has built the world's largest hedge fund around it. And in the last 90 days, he has been doing something quieter and more interesting than any of his public statements. He has been telling anyone who will listen that we are entering a phase where the same 4 assets that survived the Weimar collapse a century ago are starting to behave exactly the same way again, right now, in 2026. Most people are completely missing this, because they are watching the wrong screen. They are watching the Dow. They are watching their 401k balance. They are watching the S&P print new highs. What they are not watching is the denominator. They are not watching what those numbers actually buy in the real world. And that is exactly the mistake the German middle class made in 1921, when the Reichsmark was still printing record highs against itself, while quietly losing 90% of its purchasing power against everything that mattered. Stay with me here, because this next part matters. There were 4 assets, and only 4 that came out of the Weimar collapse with their owners' wealth intact. Some came out richer than they went in. The data on which assets did that is not theoretical. It is documented, named, and repeatable. And the pattern is reasserting itself right now in measurable dollar-denominated terms. If this is the kind of analysis you want more of, hit subscribe. I publish this every week. Here is where most financial channels lose you. They jump straight to the crisis without explaining the machine underneath it. Dalio built his entire framework around one insight: the economy is not random. It runs on cycles. And if you know which cycle you are in, you know which assets survive and which ones get destroyed. There are 2 cycles that matter right now. The short-term debt cycle runs 5 to 8 years. It is the familiar recession recovery rhythm. The Fed raises rates, borrowing contracts, the economy slows, the Fed cuts, borrowing expands again. You have lived through 4 or 5 of these in your lifetime. They feel significant. They are actually minor. The long-term debt cycle is the one Dalio loses sleep over. It runs 50 to 75 years, and it does not end with a recession. It ends with a deleveraging, a structural unwinding of decades of accumulated debt that fundamentally resets the relationship between money, assets, and purchasing power. The last time the United States hit the end of a long-term debt cycle was 1944. That produced Bretton Woods. Before that, 1971, when Nixon closed the gold window. Before that, the Great Depression deleveraging of the 1930s. Here is what Dalio's framework tells us about this exact moment. The United States entered 2026 with debt to GDP above 120%. Interest payments on that debt crossed $1 trillion annually. The Federal Reserve, which should be tightening to fight inflation, is instead being pressured to cut rates to service the debt load, which means the real return on holding dollars is already negative for anyone paying attention. That is not an opinion. That is the mechanism Dalio describes in The Economic Machine. Applied to today's numbers, the Weimar parallel begins exactly here, not with the hyperinflation, with the moment the government decided that printing was easier than adjusting. Germany made that decision in 1919. The inflation did not arrive until 1921. The hyperinflation did not peak until November 1923. The decision and the consequence were separated by 4 years of normalcy that lulled everyone into thinking the worst had passed. Think about that for a second. We are somewhere in that 4-year window right now, and the 4 assets that worked in Weimar, they are already moving. Let me show you the Weimar sequence precisely, not the headline version, the actual stage-by-stage breakdown, because when you map it against 2026, the overlap is uncomfortable in a way that is hard to dismiss. Germany in 1919 exits World War I carrying war reparations of 132 billion gold marks. That number is not payable. The government knows it is not payable. But rather than restructure openly, rather than take the short-term pain, they make the decision that every heavily indebted empire has made at this stage. They choose the hidden tax. They print. Stage 1. The currency weakens gradually. Most citizens do not notice. Assets priced in marks appear to rise. The stock market climbs. Nominal wealth looks intact. This is the phase that traps the middle class because everything looks fine until it does not. Stage 2. Import prices rise. Commodity prices rise. Citizens feel it at the grocery store and the fuel pump before they understand why. The government blames supply chains. They blame speculators. They do not blame the printing. Stage 3. The bond market starts signaling. Foreign holders of German debt begin quietly reducing exposure. Yields rise. The government needs to borrow more to cover the widening deficit. The debt spiral tightens. Stage 4. The collapse compresses. What took 3 years to build unravels in 18 months. By November 1923, a loaf of bread cost 200 billion marks. A wheelbarrow of currency cannot buy a newspaper. Now map this against the United States in 2026. The dollar fell 39% against gold in 2025 alone. European pension funds, Sweden's Electa, Denmark's Akademiker pension, have already begun quietly exiting U.S. treasuries. Foreign inflows into U.S. assets have dropped 40% since 2021. Dalio himself has identified America as sitting firmly in Stage 5 of his 7-stage empire decline framework and describing Stage 6 as the war stage now approaching. But this is where the pattern gets uncomfortable. The 4 Weimar assets that survived did not survive by accident. They survived because of a specific mechanism, and that mechanism is operating right now, in real time, in the 2026 data. If this historical parallel is landing, give this video a like. It genuinely helps more people find this analysis. Here is what you need to understand about the 4 Weimar assets and why the current data confirms they are moving again right now. The 4 assets that protected wealth through the Weimar collapse were hard commodities, productive land, foreign currency holdings, and gold. Not stocks, not bonds, not savings accounts. The people who held those 4 things came through 1923 with their purchasing power intact. In some cases, they came through richer because they could buy collapsed assets from the people who held none of them. Now look at what the data is showing us in 2026. Gold returned 65% in dollar terms in 2025, outperforming the S&P 500 by 47 percentage points. Measured in gold, the S&P 500 actually declined 28%. That is not a gold story. That is a dollar story. The number on your brokerage statement went sideways or slightly up. The purchasing power of that number went down significantly against the hardest asset on the planet. The U.S. bond market entered 2026 with its steepest yield curve since 2021, with the spread between 2-year and 30-year treasuries reaching 140 basis points. What that signals is this. The market is demanding higher compensation to hold long-dated U.S. debt. That is not confidence. That is a risk premium. That is the bond market quietly pricing in the possibility that long-term dollar obligations are less safe than they were 12 months ago. Here is what the data is actually showing us. U.S. debt interest payments have already crossed $1 trillion annually, which means the government is now borrowing money specifically to pay interest on money it already borrowed. That is stage 3 of the Weimar sequence. That is the tightening spiral. And Dalio said at the World Government Summit in Dubai this year that the world is on the brink of a capital war, where countries attack each other through controlling the flow of money rather than through military force. Most people are completely missing what that phrase actually means for their savings. And this is the part that changes everything. Here is what the decision makers are actually thinking, and why it matters more than anything you have heard so far. The surface story on the 4 Weimar assets is simple. Hard assets beat paper assets during currency debasement. Everyone who covers this topic stops there. That is not the real story. The real story is the mechanism that makes this happen, and why that mechanism is structurally locked in right now in a way that makes the historical parallel almost impossible to break. Here is the unified insight. Connect these 3 data points. Dalio has said explicitly that when countries go broke, they always follow the same sequence. They print money, devalue the currency, and create artificially low interest rates so that bondholders receive returns that fail to keep pace with real inflation. That is data point 1. The mechanism is confirmed and named. The dollar fell 12% against the euro, 13% against the Swiss franc, and 39% against gold in 2025, while all fiat currencies simultaneously depreciated, meaning the weakest fell the most and the hardest currencies strengthened the most. That is data point 2. The mechanism is already executing. Dalio noted that gold now ranks as the second largest reserve currency in the world after the dollar. and that central bank monetary policymakers themselves describe gold as the safest money in this environment. That is data point 3. The institutional response to the mechanism is already underway. Now connect them. The mechanism is confirmed. The mechanism is executing, and the institutions that manage the world's sovereign wealth are already repositioning into the same 4 asset categories that survived Weimar. They are not doing this loudly. They are not announcing it. They are doing it in the treasury data, in the central bank gold purchase figures, in the sovereign wealth fund allocation shifts that most people never read. What Ray Dalio's framework tells us about this exact moment is that we are inside the window where institutional repositioning precedes public awareness by 60 to 90 days. That window does not stay open permanently. The all-weather logic for this specific debt cycle stage points toward hard assets, inflation-protected instruments, and non-dollar currency exposure, not as a prediction, as a pattern that has repeated across 4 distinct historical parallels in the last 100 years. I want to know what you think. Drop a comment below. Do you think this is a beautiful deleveraging or an ugly one? Because the answer to that question determines everything that comes next. But the other side tells a different story. And I want to give it a fair hearing before I tell you why I think it breaks down. The optimistic case is not stupid. It is actually well constructed. And if you are going to understand why the pattern matters, you need to understand the strongest version of the argument against it first. Here is that argument. The United States is not Weimar Germany. Weimar was a defeated nation, stripped of its industrial base, forced to pay reparations denominated in a foreign currency it could not print. The United States controls the world's reserve currency. It borrows in its own denomination. It has the deepest, most liquid capital markets on Earth. It has navigated debt crises in 1971, in 1987, in 2008, and in 2020, and each time the dollar survived and in some cases strengthened. The Fed has tools Weimar's Reichsbank never had. The counterargument says, this is not collapse, this is managed adjustment. Currencies fluctuate. Gold spikes during uncertainty and retreats when confidence returns. The 65% gold return in 2025 is a fear trade, not a structural signal. There is also the dollar alternative problem. What replaces it? The euro is structurally fractured. The yuan is not freely convertible. The ruble is a sanctions risk. Gold cannot settle trade at scale. The dollar, for all its problems, remains the least broken option in a field of broken options. That argument has real weight. I want to be honest with you about something. That counter-argument held up well between 2010 and 2022. The data supported it. The pattern suggested resilience. Here is precisely where it breaks down in 2026. The optimistic case requires that foreign capital continues flowing into U.S. Treasuries at sufficient volume to fund a deficit that is now structurally unreducible. Foreign inflows into U.S. assets have already dropped 40% since 2021. The optimistic case requires a trend that is already broken to reverse without a catalyst that currently does not exist. And that gap between what the optimistic case requires to be true and what the flow data actually shows is exactly why the next section matters. So let us stop talking about empires and debt cycles for a moment and talk about what this means for your money specifically. You have probably noticed something already, even if you did not have the framework to explain it. Your grocery bill is higher than it was 3 years ago. Your rent or mortgage payment consumes a larger percentage of your income than it did in 2021. Your savings account is nominally intact but buys less every quarter. You are working the same hours, earning similar numbers, and falling behind in real terms. That feeling is not psychological. It is mathematical, and it maps precisely onto stage 2 of the Weimar sequence. Here is the mechanism for each area of your financial life right now, your savings account. Dalio has said the strategy governments always use is to create artificially low interest rates so that people holding deposits receive returns that fail to keep pace with real inflation. If your savings account yields 4% and real inflation is running 6 to 7%, you are losing 2 to 3% of purchasing power annually without the number ever changing. That is the hidden tax. That is exactly how Weimar eroded middle-class wealth before anyone understood what was happening. Your retirement account, measured in dollars, your 401k may look stable. Measured in gold, the asset Dalio now describes as the world's second largest reserve currency, the S&P 500 lost 28% in 2025. That loss does not appear on your statement. It appears at the checkout counter, your borrowing costs. The yield curve entering 2026 is the steepest since 2021, which means long-term rates are rising independent of Fed policy. Mortgage rates follow long-term yields. Every month this continues, the cost of carrying or refinancing debt increases. Your cost of living, hard commodities, food, fuel, materials are the first Weimar asset category. They rise when currency weakens. They have been rising. In the 1970s stagflation, the closest modern parallel to this stage of the long-term debt cycle, a $50,000 savings account lost 40% of its real purchasing power over 7 years. The number stayed the same. The world it could buy shrank dramatically. Think about that for a second. If this kind of specific analysis is what you are looking for, subscribe to the Reid Briefing. This is exactly what we do every single week. So here is where this goes, and I am going to be direct because that is the point of this channel. Short term, the next 30 to 60 days, gold continues absorbing capital. With gold already at $5,170, and analysts at BNP Paribas saying $5,000 once looked extreme but is now within sight of being surpassed, the institutional bid underneath this market is not speculative. It is structural. Central banks are buying. Sovereign wealth funds are reallocating. The retail investor is the last to know, which means the short-term window is still open, but it is narrowing. Now, the two midterm paths, 6 to 18 months out, the escalation path. The debt death spiral tightens. Higher yields balloon interest payments already running at $1 trillion annually, forcing more borrowing, which drives yields higher still. Foreign treasury demand continues its structural decline. The Fed faces an impossible choice between fighting inflation and funding the government. It chooses the government because it always has at this stage. The dollar loses another 10 to 15% in real terms. The four Weimar assets, gold, hard commodities, productive land, foreign currency exposure, continue their historical role as the last functioning stores of value in a system under pressure. The resolution path. Congress passes a credible long-term fiscal framework that arrests the deficit trajectory. Foreign capital confidence partially restores. The yield curve stabilizes. The debt spiral slows without snapping. This is possible. It has happened before, the 1990s Clinton-Gingrich budget surplus being the clearest recent example. But it requires political conditions that do not currently exist in Washington. The probability is real. The prerequisites are not. Based on every historical parallel in the last 300 years of debt cycle data, the more probable outcome is the escalation path continuing until an external event forces a response that should have come earlier. Every empire that reached this stage believed it was different. Every single one was wrong. The four assets Dalio is pointing at are not a prediction. They are a pattern. The pattern is speaking clearly right now. The only question is who is listening. If you want to be here for the next update, subscribe and turn on notifications, because when this moves, it will move fast.